Welcome to Massive Passive Cash Flow, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Hello, this is Gary Wilson, and welcome to Massive Passive Cash Flow Podcast. Welcome back, everybody. We're glad to have you on board. For those of you who haven't done so yet, if you could please go ahead and subscribe. The podcast is on 30 different channels, including, of course, Stitcher, iTunes, iHeartRadio. And thank you very much for the downloads. We're now being downloaded in more than 50 countries. I appreciate that. We do work with investors all over the world. I personally work with investors from 13 different countries, okay, investing here in the U.S., and this, of course, real estate related. By the way, if you haven't done so recently, go to the website, realestatewithgarywilson.com. Click on the members area tab up on the top where the taskbar is. Click on members area. If you're already a member, you know what to do. On the left-hand side, you log in. If you're not, you go to the right-hand side and go in for free for 30 days. And you can get all kinds of good stuff there. And one of those things is you get to contact through our community site over 100 investor agents that are now across the U.S. in 24 states, from Hawaii to Maine and everywhere in between. Okay, this is really, really important. We started attracting them about last fall, and there are a lot of them I've trained myself, I've taught, and they're certified. I know they are because I'm the only place that they can get certified from. And these are residential investor agents where we do commercial work. We work with owner occupants. For the most part, it's single families, duplexes, triplexes, and fourplexes, and flipping. So in any case, enough said. We got a great guest today. Mark Myers is on board. He's got a great background. He's a former serviceman in the U.S. military, and also has a wealth of knowledge when it comes to tax strategies in the IRS. So Mark, welcome aboard. I appreciate you coming on to do this.
Gary, I'm so happy to be on your show. Real estate investing it's just such a special place to be. I think so many more people need to be putting their assets into real estate. And I really appreciate your podcast and what you do in this space. It's phenomenal. So thank you for having me on the show. And, real estate investors are sometimes my best friend because, we can really help them navigate the capital gains tax issues that they have when they're exiting certain properties. So excited to talk a little about that and a lot more today.
Yeah, this is such a great topic, and it's so timely too because of all the talk in Washington, D.C. about raising capital gains from 15 to 39% and eliminating 1031 exchange over 500,000. I mean, that's a lot. That's a lot of impact there. And listeners, for those of you listening, I know many of you are dentists that own multiple practices and chiropractors and engineers that have consulting firms, as well as teachers and pilots and military active duty retired and just a myriad of people, but a lot of more highly educated people and a lot of business owners, and they'll learn, just like we all do, the IRS tax code is there to be used. Generally speaking, none of us have time to learn that because it's the largest body of law that we have in the land. It's like hundreds and thousands of volumes. It's just crazy. So thankfully, we have service providers like Mark to help us navigate that crazy path. Hey, Mark, so if you wouldn't mind, though, you have an interesting background. Would you mind sharing a little bit? Just give us some context, and then we can jump into what I call the meat and potatoes.
I'd be happy to, Gary. Thanks for asking. And speaking specifically to business owners, just note, my comment about mitigating or eliminating capital gains tax. We can do very good things for active income tax for business owners as well. So to give you some background on me, I actually managed really high-end health clubs for my first 12, 15 years of career. I went to the University of Florida, did my undergraduate work in exercise physiology and master's work in sports management, and I managed multi-million-dollar health clubs in New York City and Los Angeles for close to 15 years. So a lot of times people ask me, well, how did you get into advanced tax planning and what are you doing in that space? Well, interestingly enough, after running successful companies for others and looking at the opportunity income-wise, I realized that I understood business. I understood how to manage a profit and loss statement. I understood how to drive revenue and minimize expenses to increase EBITDA margin. So I left that industry in 2007 and started working specifically with business owners. And over the last 14 years, I've really year over year began to accumulate relationships with advanced tax solutions providers. So essentially what I've become is a self-proclaimed tax broker, so to speak.
Okay.
So if you think about the work that's being done, I am not the one that's directly doing it. I have a dozen or more relationships with different groups that do what they do very well. And depending on the need of the individual, I will bring in the right resources to solve the problem.
Okay.
So it's been a fun a journey over the last, 13, 14 years. And the relationships that I have that can solve these problems are some of the best in the industry.
Wow. Well, I really appreciate that. And I furthermore appreciate what you're doing, because I know I've been I was in banking first for a lot of years, and then retired when I was 40, and been doing nothing but real estate, teaching, coaching, training, investing, running several companies, brokers companies, title companies, property management companies. And now even though it doesn't look like I'm retired, I actually am retired, because I pretty much work from wherever I want, and I get to do fun things like this. But one thing that really caught my attention when I was doing a little research, and everybody listening, just know this, we always research everybody. And man, let me tell you, Mark is definitely the real deal. And one of the things that caught my attention, Mark, is how we can reduce personal income tax by 30 to 60%, of course, without changing your CPA or using an investment strategy. We can we can start there. That'd be a great place to kick this off with,
Absolutely. And that's, I think that for the majority of individuals, Gary, when you think about tax reduction, they're thinking, okay, 401k, SEP IRA. They're thinking if they've got a more advanced financial advisor, they're thinking defined benefits plan or cash balance plan. They might be thinking insurance products, right? Because you can invest, you can place money in insurance products and it can grow tax deferred and potentially even come out tax free. Mm-hmm. Those are the kind of things that most people think about. But when you start thinking about how do you reduce tax without having to invest in any type of investment product or vehicle? How do you reduce tax without having to leave your trusted CPA of 10 or 15 years? Right. That's where you start bringing in the advanced tax solutions. And I think the best way to look at this is, just like a football team, a national championship football team, they have way more than just a head coach. Right. So in the business world or in the investment world, if all you are relying on is your CPA and perhaps a good investment advisor, you don't have the team that you need to navigate the 70,000 plus pages of tax code that you can use to your advantage in sales transactions, and also with moving income from your business to yourself in a much more tax efficient way. 55 of the top Fortune 500 companies last year had billions in profit, but paid zero federal income tax. How does that work? Yeah. So our groups know how to navigate that. And fortunately, they work with small to medium-sized businesses, and of course, business owner or individuals that are selling highly appreciated assets. Yeah.
Well, I tell you what, that'll certainly get people's attention. Is there now? I know you have fiduciary obligations with your clients and not disclose certain things. But is there a case study? You can think of a case study, maybe your first client, your last client, or maybe your favorite client. An example of somebody who maybe was a small business owner, and what did they do, or how did you help them? I guess in a broad enough context where we can get it in to the podcast time frame, but maybe just enough detail to let people know, hey, there's real science behind this.
Absolutely, Gary. I got a lot of different examples, but we'll focus on kind of more of the basics. So if we're thinking about active income, we're thinking about income generated from someone's business. Mm-hmm. Say they're a chiropractor, a dentist, or a physician, or a lawyer, or a contractor, or a real estate agent. Most of our clients, when they come to me and they say, Mark, I'm just tired. It's so painful to write those quarterly checks or that annual check. How do I reduce that? Because my CPA tells me we're doing everything we can. And it's just part of the pain of being successful. So is there anything more we can do? So the first thing we do is we take a legal approach and we say, how are you structured? Mm-hmm. And 99.9% of our clients are pass-through entities. They're LLCs, LLPs, an S corp, some type of entity, even sole prop. Sometimes we work with individuals that are sole proprietor, and whatever they can expense or deduct or maybe defer, right? Because when you're doing some type of qualified investment, you're just deferring. I always say you're procrastinating. It's not the worst thing you can do, but it might not be the most appropriate. So we look at how they're structured, and there could be ways to add additional layers of structural efficiency to move their profits to them more succinctly and more tax efficiently. So I'll give you one specific example for that.
Okay.
Real estate broker in Southern California, $4.2 million worth of commissionable volume. GCI, gross commissionable income in a year's time. Very, very consistent with that.
Okay.
Pretty high marketing expenses. So he spends a lot of money marketing his services as well to acquire that level of commissions. So the first thing we do, and this is what we do with most clients, we call it low-hanging fruit. We look at creating a additional entity that would service the main entity that's designed specifically for that business owner and their family. Most of the wealthiest individuals in the nation have a structure in place like this, and it's only created to utilize fringe benefits that are buried in the code to their benefit. So the reason that we create this additional entity to support their main entity and make sure it only services the family, because if they were to create these fringe benefits and place them into entity that they currently have, they would have to offer these fringe benefits to all of their employees. They don't want to do that because these benefits would essentially cost them money if they had to give it to their employees. But if they brought it into their own private entity, we call it a personal marketing and management company.
Okay.
So essentially what it does is it invoices the main entity for marketing and management activities.
Okay.
So here's the question I always get is, well, why would you do that? You're just moving money from one entity to another. Why is it more beneficial to move it to this new entity that you've created?
Yeah.
Well, the personal marketing and management entity is only going to invoice the main entity the amount it can extract using tax-free fringe benefits. And that's usually anywhere between, in my historical experience with all the analysis work that we do, anywhere between $75,000 and $150,000 per year. And there's about 20 different tax codes that basically say you can take this out of the company as a benefit, meaning that it's not taxable because it's not income, it's not a dividend, it's not profit above income, it's not salary, it's a benefit. And a lot of these benefits you're not currently taking deductions on, but you could, or you can create the deduction that has no expense related to it. So that's our first step, is to say, how do we take your first $75,000 to $150,000 tax-free via an entity that we create specifically for you and your family? There's about 20 different ways we can get money out of it without having to classify it as taxable income. Wow. So that is solution. Now that I will say, Gary, that's very enticing because people like to pay no tax on 100, 125, just depends. Every situation is a little bit different. But when we're working with business owners that say, well, that's great, but I'm paying taxes on 1.7 million. What are you going to do with the other 1.55? That's when we go into other levels of strategies or other layers of strategies. But I'll stop there. Hopefully that made a little bit of sense with regard to our first level of defense, I would say.
No, it definitely does. And the reason I like it is, there's always talk of people, moving overseas because there's programs that allow them to reduce or eliminate taxes if they go to another country and spend 10, 15, 20, whatever the requirement is. But yet you've got to leave the United States. A lot of us, we don't want to leave the United States. We've got family here, children, parents, the whole nine yards. And, I know in my limited experience, I've been able to reduce my tax burden legitimately just by a few simple moves. And they're not even as complex as what you were describing here. And that's the simple strategy. That what you just described there, anybody listening can understand that. I mean, I haven't known that before. So thank you for sharing that. And, I've thought about going to, like, for example, Puerto Rico, where you don't have to give up U.S. citizenship, but you do have to live there and buy a home there, and you've got to set up your business there. It's a disruption, and you can't come back to the United States more than half your time. So it's still not palatable. So if there's ways to like we just described there, and just for everybody listening knowing this, there are all alternatives right? And that's why Mark is trying to help explain these to you. So you don't have to think about packing up and moving away and all kinds of things like that. I know people do that. And I know some people personally, and I'm thinking, boy, I just don't know. I like being able to hop in my car and drive across town and see my children, so if I'm in Puerto Rico, you can't necessarily do that. So, hey, I tell you what, that was a great example, a great case study. Now, what about the next hot topic, which is capital gains? There's lots of discussion in DC about raising capital gains from 15 to 39%, but I'm pretty sure there's strategies that we can implement that may or may not be impacted by that. So what can you share with us when it comes to capital gains? So a lot of investors are facing that at some point. We're gonna sell at some point, So.
Absolutely. Capital gains tax can be daunting because a lot of people work so hard for their entire life, whether it be building that business on their back and they're finally ready to exit that business and somebody wants to pay a good amount for it, or maybe they've been building a real estate portfolio and they have a few pieces of that real estate portfolio that they're ready to sell. And now they're looking at that 15%, 20% if it's above $1 million. Obviously, if their taxable income is above $1 million, now you're looking at the 3.8% on top of that, which is more of a FICA Med Obamacare type tax. And then you have to add the state tax. So when we're working with clients that are selling appreciated assets, whether it be a business or ownership stake in a company that's privately held, we can't do this with Google stocks, or they're selling a piece of real estate that's highly appreciated and their basis is low. Well, they're looking at a lot of profit that they have to pay taxes on. If they're in California or Illinois or any state outside of, Washington and Nevada and Florida, and Tennessee, they're looking at a state tax on top of that federal capital gains tax. So the key with this, there's a lot of different ways to actually reduce and eliminate capital gains tax on the sale of a highly appreciated asset. Mm-hmm. The best ways that give people the most flexibility is to structure the sale appropriately prior to signing the contract and taking constructive receipt of the proceeds. A lot of people don't realize. They come to me and they say, Mark, I just sold a property for $2 million. I had a $1.2 million gain on it. I owe the IRS $300,000. What can I do? And I'm like, well, I wish you had told me at least 2 weeks before the sale, but give me a little time, 30 days before the sale's better. So the structuring is key, because if you can structure the sale where you don't take constructive receipt of the proceeds, you direct those proceeds to maybe a qualified intermediary, a trustee, or a trust. And now when that sale happens, the buyer is instructed to pay the person or the entity that you're instructing them to pay, meaning that you didn't take constructive receipt of the proceeds. And the reason why you do that is because when that money is in that environment, the capital gains tax wasn't triggered. So now you have that dollar amount less the transaction fees to put to work for you. And a lot of people love this because it's an alternative to a 1031. Alternative to a 1031, because as we know, when you sell and the market's high, well, you're probably going to have to buy when the market's high. You've got 45 days to identify and 180 days to close. So we're saying, well, it's great that you can defer the tax, but you're going to have a hard time finding a property that potentially is as good as the one you found. So why don't you use a properly structured 1031 alternative, and let's put this money in. Maybe it takes you 6 months. Maybe it takes you a year. Maybe it takes you a year and a half to find the right property to buy. But guess what? And with these structures, a lot of times you can reset the depreciation. So when you do a 1031, you have to carry the depreciation over. With these structures, you can reset the depreciation. So now you have a brand new depreciation schedule, in addition to having a lot more time to purchase your next asset. And you don't even have to purchase real estate. Let's say you want to get into a business. Let's say you want to do some blend of stocks and equities. Let's say you want to buy tangible gold. You can do pretty much what you'd like, depending on the structure that you create to put this money in.
Well, I'll tell you what, that interesting subject is trust, because I know ever since January, February, when there's been more talk of the 1031 exchange, being eliminated over $500,000. That's big that's half of California, that's half of New York. A lot of people are affected by that. But the talk has been using trust as an alternative, and we had another gentleman on a while back talking about trust, and I wish I could tell you, I remembered more than I forgot, but that would not be true. So with a trust, then, if you construct in your sale agreement, if you construct it so that the proceeds go into a trust, and I know there's all kinds of. I personally have what's called an asset protection trust. It's an irrevocable trust. It's Nevada Asset Protection Trust. But there's all kinds of other living trusts and trusts that are revocable, and it's just a whole body of knowledge. But what actually happens when you don't actually put the asset into the trust and sell it there. You sell the asset and you direct the funds, the proceeds that go to the trust. But because of that, they're inside the trust. It's not a taxable event for capital gains. So those funds, I just kind of replay what you were saying. Those funds can then be used or repurposed, not just for real estate investments, but other types of investments, which is really neat because that means they don't have to be like-kind investments like a 1031 exchange is. So did I beat that up like crazy, or did I get close?
No, you did it perfectly. I mean, essentially, the benefit here is because you didn't take constructive receipt of the proceeds, which is what triggers the capital gains event. Because you did not do that. You structured the sale to where you weren't receiving the money. And if you had to receive the money, or directed it into an entity that you have more, you have ownership of, then the IRS says you took constructive receipt, you owe us a capital gains tax. Yeah. By doing this, whether it be, and again, there's three different ways to do this. One way is to create a trust environment that allows for you to reinvest 98.5% of the sales proceeds because there's a 1.5% fee to structure it. And now you have 98.5% into this trust environment, and then you can reinvest, and you have some flexibility on what you reinvest in. You can reinvest in real estate, absolutely. You can reinvest in other things. You can reinvest in businesses. Now it's a deferral mechanism. So now when you're actually taking distributions from this trust, well, you will pay your pro rata capital gains tax at that time, but you might not need all the money at once. It might be that you put 98.5% to work. You're continuing to earn interest on that or earn returns on that money. Well, you're not paying any taxes on it until you say, I need $20,000 for a living expense or for something I need that doesn't need to stay in the trust, because you can keep your real estate investments in the trust. You can continue to turn your other assets that you're purchasing in the trust. So you're only paying taxes pro rata as you distribute. And there's a lot of flexibility in the distribution pattern because it's basically an installment sale, but you control the note on the installment sale. So that is one method. And there's other methods that we could talk about too, which give a little bit more latitude with what happens with the money. But I'll stop there because I don't know if you want to go, how deep you want to go and how many directions you want to go. But I guess the key, what I want to say, Gary, is if you can redirect and control, the key is you control the assets. You just redirect them so you don't take constructive receipt. In that environment, there's a lot of things that you can do to repurpose the money, continue to grow the money, not pay taxes until you need the money. And you can basically take smaller amounts as you go. Now, of course, there is a complex trust system that allows for you to completely eliminate the tax. That's a whole nother concept, but we can get into that maybe if you'd like, or we can go down another path. I just want to make sure I'm staying on target here.
We can. I definitely want to have you on again. We could do we'll call this one-on-one. We could do a 202 class.
I love it. Absolutely.
Like in the college days. But one thing that came up that was important is you mentioned, so if you do that and you direct the proceeds to be paid into the trust, if you personally pull money out, like it becomes you to put it in your pocket, then yes, that would probably be taxable. You'd have to pay some taxes if you did nothing else.
Exactly. So think about whenever you take a distribution from the trust in this first situation, because there's other situations that don't classify the same way. So you can use the money in more tax efficiently. But in this first situation, you might take a percentage of the sales value, right? And use it outside of the trust because you needed it. Well, you're going to have a basis to that, which you don't pay taxes on. So you don't pay taxes on the basis portions. There's a percentage of that went into the trust, that's basis. So anything above basis, you're going to pay the current capital gains tax rate at that time on that amount. So essentially you're paying a lot less capital gains tax because you're taking a smaller piece out. And of course, the idea is that if you can redirect 98.5% of the asset's value or sales price and start reinvesting it immediately, then of course you get ahead of the tax curve, because otherwise you would have lost anywhere between 15 and 33%, right? Like just like that, because the IRS would have their hand out.
Yeah. What's interesting too is, so let's say you directed proceeds from the sale of an asset, a piece of real estate, into a trust. You could then use the proceeds inside the trust to reinvest, like we talked about, into another piece of property. But and some trusts, I don't know if they're all trusts are like this. Let's say you want to liquidate that. Instead of selling the asset inside the trust, can you sell the beneficiary rights to the trust and the trustee rights? Can you do that? I mean, is that 202 level, or is that?
No, great question, Gary. I mean, essentially, when you start looking at assets within a trust, you have to be careful about when you're starting to take distributions from the trust to the personal side. There's always going to be a taxable event. So any type of transfer of assets either needs to remain in the trust, or it needs to go trust to trust. So essentially, you might be able to move assets from a trust to another trust. Okay. And then, of course, the proceeds stays in your trust if you're selling assets. So there's ways to do it. But again, that's more of a 202. But I will say, when it comes to the different solutions for utilizing trusts, another pathway we can talk about is a monetization of a sale, which a lot of people like to use because they essentially can sell their asset, pay a approximate 6.5% structuring fee to have an asset dealer essentially give them 93.5% of the sales value unencumbered, not in a trust. It's not even in a trust. It's basically a 30-year interest-only note that the asset dealer has agreed to pay the interest for them and also repay the principal at the end of the note. So what happens here is you've got 30 years time value of money unencumbered outside of a trust to reinvest. And at the end of the 30 years, when that note is paid off, well, that's when the taxes are due. But a lot of times people look at, well, if I pay the taxes now, I've got to give, 25 cents on the dollar to the IRS. Well, if I utilize this structure, I keep 93.5 instead of 75. And that delta is a big number. And if I have 30 years to continue it and reinvest this 93.5% I have in my pocket now, I'm not concerned about the capital gains tax in 30 years, because if you do it right, it could be a 75% capital gains tax and you still significantly outperform even at a low compounding return. I mean, I've done numbers on 6.5%, 7% of just taking a piece of the savings, and you still outperform the tax bill at 30 years, even at double the capital gains tax rate or triple the capital gains tax rate. So it's really using time value of money to your advantage. Yeah.
Well, it just goes to show, at the very beginning, we talked about the fact that there's an entire body of knowledge related to the IRS tax code, and it's written for us to be used. That the challenge is most of us, we don't have the capacity to learn all that. So thankfully, Mark, you've come on board to share this. So there's one more question, since we talked about the IRS tax code, as how generous is the IRS? How can we use the IRS to help fund a portion of our own retirement?
Well, that is a great question, Gary. And I think that when we go back to the first question that I addressed for business owners, when you think about every single year, by having a personal marketing and management entity that can take $100,000 to $150,000 per year tax exempt, right? Because it's a benefit. Well, that is normally $100,000 or $150,000 that you would have paid taxes on, because it would have fallen like a waterfall onto your 1040, and you would have to pay the IRS. So if you think about when you move that and recategorize that income into a different entity and move it out in a tax exempt way because it's a benefit, well, now every dollar that you didn't have to pay the IRS, you can reinvest. And a lot of people that like utilizing insurance will start overfunding insurance maximally, right? So now that dollar that they didn't have to go to the IRS, now they kept it and they put it into an overfunded insurance product. And now they never pay the taxes again. And it's growing, depending on their age and, of course, their health rating. and the product you use, you might be growing at anywhere between 4 and 6.5 points, and you can borrow against it.
Yeah.
Anytime. So real estate investors, when they really get their head wrapped around this, they love it because now their overfunded cash value life insurance policy gives them like a 4 to 6.5% tax-free bank account as a seed account for their new investments, for their new real estate investments. And guess what? You've got some death benefit there that basically you have to have because it's a lot. The IRS says for this amount of dollars in this product, you have to have this amount of life insurance minimum. Well, that becomes then handy when you're a good investor down the road because you might be looking at estate tax issues, and also, of course, you're also looking at just protecting the family as well. So a lot of times, I always say, if you can shave off money and you don't have to put it in that type of environment, but that way you would never pay the taxes again. And of course it would continue to grow compounding at whatever the rate is in that instrument. So that's one way I think people like to use.
Well, I love the whole concept of using trust. Like I said, I have one myself, and the reality is a couple things, trust and whole life insurance policies too. But with trust, if you think about it, whenever a new administration comes in the office, or there's another election, and they're touting their plans, and they're going to change this or change that, they're going to tax the rich folks more and all that kind of stuff. Now, have you ever noticed how in all the years politicians have been sitting up on their soapbox? They've never ever once said, "Hey, we're going to rewrite the trust laws." Never have.
That's
right. Never will, because they all have trust, and it's one of the oldest bodies of law. The IRS tax code is the biggest. Trust law is one of the oldest. Goes back hundreds and hundreds of years. The landlords back in England used trust to protect their assets and create legacy going for their descendants going forward for generations. And with the whole life policies, using the cash value of whole life policies. That was always a method of the uber wealthy for a long time. It's only until recently where other companies are coming into the business and creating new products that have a lot of other features and benefits that make it more appealing, but also more accessible for other folks other than just the uber wealthy people. Obviously you have to have some wealth and income to participate at some level, but even if it's like it just at the beginning, you just start with who you are and where you are and who you know and what you know. And if it's one small little duplex or something, or a half of a house like I did, I bought half a house, my first house, split it with Socrates, my roommate. That's how I got started. There was that was my beginning. But here I am now, all these years later, taking advantage of some of these things. So, what I want to do, Brian, is any final words of wisdom? Or I know we're getting close here. We probably should wrap this up, but I want to thank you because this has been an awesome topic, and I definitely want to have you back. But any final words of wisdom on the subject here?
Gary, absolutely. And what I'll do is I will give you a teaser on a 202. So hopefully we'll be talking again soon. So first, the recap. If you're selling an appreciated asset, make sure you determine ways to structure the sale prior to actually taking constructive receipt, so you can defer or potentially eliminate, because you talked about trusts, and there is a trust, a specific type of trust that is not a deferral trust. It is a spendthrift trust that does eliminate tax. So we could talk about that in 202. So it's always structuring the sale prior so you don't take constructive receipt. And if you need help with that, obviously I would love to be able to be a resource for you. My website is peakprofitsolutions.com. Very easy, peakprofitsolutions.com. You can always go there and just find a time on my calendar to chat. I have no problem getting on a phone call with someone and really just analyzing their current situation and giving them some resources to move forward with helping. Now, as far as the Puerto Rico side, when it comes to active income, believe it or not, there is a solution that a lot of business owners can use to pull a portion of their profit into Puerto Rico and take their profit there at a tax-exempt dividend without having to move there and living 183 plus days per year. So maybe that's a 202. So when it comes to active income, outside of the personal marketing and management company that I talked about, taking the first 75 to 150, we can talk about economic development zones in places like Puerto Rico, or we can also talk about more complex trusts that will essentially eliminate tax, not just defer it, if the situation is appropriate. So excited about just continuing this conversation, Gary, and hopefully talking to those that listen to your podcasts and they love what you have to say, and hopefully they'll need a little bit more information on this when the time is right.
Yeah. So, well, thank you very much, by the way. And for everybody listening, remember peakprofitsolutions.com. Mark Myers is your man. And if everybody had a voice right now, I'm sure if I said, let's take a vote, should we have Mark back? I'm sure that'd be a resounding affirmation. So, so in any case, for everybody listening, by the way, thank you very much for taking your time to participate in the podcast. We rebranded about last fall. It's been growing like crazy. Welcome aboard if you're new. Stay tuned. We've always got great guests like this. This was particularly special. So if you haven't done so, please subscribe to the podcast. All right, Massive Passive Cash Flow Method. Go to the website realestatewithgarywilson.com and go to the members area. If you're not a member, go to the right-hand side. You'll get in for free for 30 days and treat it like Christmas time, because we make it available possibly to get 5 books for free, over 300 recordings on things like 1031 exchange, just dozens and dozens of websites you can use for research, and more importantly, the community site where you can identify a trained investor agent. They're trained to work with us investors, okay? That is one of the most important things. Your team is your most important thing, and team means having somebody like Mark on your team, an investor agent on your team, right? The right people on your team to help you succeed. So, and Mark, thanks again for taking your valuable time. I know you're busy too, and I know you're successful, and I know this is a real special treat for us to have you. So thank you again from the bottom of our heart.
Gary, it was a treat for me. Thank you so much for having me, and I look forward to our next conversation.
Me too. That sounds good. And for everybody, God bless you and your families, and we'll see you on the next podcast.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.